What's up everyone, my name's Robbie, this is Robbie M. Neal, and today we're talking about how I'm investing in this bear market. A few short videos ago, I compared the current stock market to that Super Mario GIF where he's like trying to get around those, I don't know what you call them, fireball things. So yeah, you could say it's pretty hard lately. I mean, I'm sure that you're going through the same things we all are, right? We are all on the same page here. And like last week, Target's down 25% after earnings. Like that's not supposed to happen. Target is not a high-flying tech stock that doesn't have any cash flows. Like, Target's a good company, right? Target's like a real legit company that makes cash flows, that actually has earnings, right? Target's a good company. That's not supposed to happen in a day, 25% in a day. And also, Snap, which is not a very big player, right? Snap, the app Snap, not a big player. So when Snap comes out and it revises its guidance downwards, and suddenly like it's taking out like Google, it's taking out Facebook, it's taking out like ICT, Interpublic Group of Companies, IPG, anyway, whatever it is, like taking out all these different companies from a company like Snap, like that's not normal. So I'm actually excited to share with you today like how I'm allocating money into this market, as I've kind of created a strategy for my current portfolio, or at least a strategy for adding new money into the market basically. This is a hard market to invest in, and what I'm doing right now, I'm actually very comfortable with how this is kind of like panned out and what I've created. So I figured you would enjoy watching this video, and so I hope you stick around, watch the whole thing. Got a lot of good info in this, and let's get started. Thanks everyone so much for watching. I do want to remind you, I'm not a financial advisor. This is not financial advice. This is just my opinion, and let's face it, I am not right 100% of the time. So please, do your own due diligence. All right, so before we begin, I do have some affiliate links below if you want to take a look, support the channel. One thing specifically I do have down there that I think you might like is a subscription to Barron's newspaper. So if you're interested in getting a newspaper weekly about the markets, it's a great publication, so take a look at that. Like and subscribe, do that stuff. So I call this the Jack of all trades portfolio. So why Jack of all trades? So basically this portfolio is not just focused on one specific way of investing, which a lot of people, that's how they do it, right? So you're a value investor, you buy undervalued stocks. You're a growth investor, you buy growth stocks. You invest in index funds only, right? You just index fund passively, right? There are specific ways that a lot of people invest. This is not that. This is a jack of all trades style of investing. You might call this multi-strategy or something like that. So let's start off with the first thing here. I have it. It's called Valmentum, and I made the name up Valmentum, and it stands for value and momentum. So what Valmentum is, and I've made 2 videos on this so far, and I will go over the returns in a second, but basically I discovered a back test a while back, and it was about basically the best back test that I had found, or at least that this website had run. And they had run back tests on all sorts of different things. They did it on ROIC, they did it on price to book, price to earnings, EV to EBITDA, EV to EBIT, like everything that you can think of, they did it. And so they did all these different fundamental back tests, and they figured out that 2 different back tests together worked the best. And the 2 factors when combined that had the best return ended up being momentum, and I use 6-month price change, so companies that have made the most money or gained the most over the past 6 months, and then price to book value. And so when you combine these 2, what you get is let's say low price to book value companies. So these are companies that are cheap because they have low price to book values, but they have momentum. So even though they're cheap, they have had a lot of price increase recently. It's just a really weird kind of way of thinking, like you're getting cheap stocks, but they're momentum stocks. It kind of doesn't make sense, right? So I love the idea. I love how it's performed so far, and it is a rules-based strategy. So what I do is I take quarterly all of the stocks that I run using the screener quarterly. I take 50 of these stocks. I invest in M1 Finance to invest in this portfolio of stocks, and I hold them for 1 year. So every quarter I run this. I add 50 stocks, so it ends up being 4 baskets over the whole year of 50 different stocks. So it's tons of different stocks. which is why I use M1 Finance for it, because it's really easy to create giant portfolios of stocks in pies with M1 Finance. That's why I use it. And by the way, M1 Finance, affiliate link below if you want to take a look at M1 Finance. So what I do is I hold these stocks for 1 year, and then on basically the day after that year, I run it again. I sell all the stocks, I run it again, and I buy a whole new basket of stocks. I do this so you don't have to incur short-term capital gains. So it's long-term capital gains. So it's a better way of basically being taxed, because I'm doing this inside a brokerage account, not an IRA. And then over here, it's cheap momentum and it's individual stocks. So that's what I got here, Valmentum. Now let me show you a quick return. So I shared this in my video recently that I did when I showed an update of how this worked. So basically, this outperformed the S&P 500 by 20%. So 20% to me is like a really good amount, and I'm very happy with that. I had a 33.29% return in this. I did not invest in this yet. And so I ran this to see how it did, and it did well. So now I'm investing in it essentially. Now I also ran this February 4th, and since February 4th, it's beaten the S&P 500 by 22.82%. It's got a 13% return. The S&P 500 is down 9.25%, right? So done very well in a bear market. I'm very happy about how these stocks have performed. This other one I did was a few weeks later on the 25th of February. Again, I did 40 stocks here. I have 40 stocks, 29% outperforming, a 33% return versus the S&P 500, 4%. So killed the S&P 500 so far over that time. So this thing is doing really good, and I'm excited that I'm using it, and I'm going to see how it goes over the next year. Okay, so Valmentum is very different from the next one, which is a tactical market recreation, and I use sector ETFs for this. So this one is I recreate essentially the S&P 500 index. Basically, I recreate all the sectors. There's 11 sectors in the stock market. So I recreate all these sectors by using ETFs that I prefer, basically, to get exposure to each of the sectors. I overweight the sectors that I favor at the time, and then I underweight the unfavored sectors, and then the ones that I'm kind of neutral on, I weight them accordingly to the S&P 500. Now, I made a video on the sector ETFs I liked going into 2021 and how the results were for that, so you can find that as well on my channel. I'll try to remember to link that below, and then also I did my favorite sector ETFs for this year, and these are those ETFs. And so far this year, these sector ETFs have outperformed. The way that I basically allocated them has outperformed the S&P 500 by 5.58%. Again, I did not. This is what I made from the video that I made. So these were all my choices from the video. This is how it's performed, basically. And by the way, all of those results I showed you before were not including dividends. I should mention that. Those portfolios that I created actually have a little bit more dividend income than the S&P 500, so it actually works in their favor a bit, just so you know. But anyway, these are just price returns, not dividends reinvested or anything like that. So I had the different sectors here. These are the different sectors of the stock market. This is how much the price was when I added it. This is the current price. This is the gain. I was overweight these three: financials, energy, consumer staples. I was equal weight these. And then I was underweight these. A lot of people probably thought I was crazy for underweighting technology at the time, but look how that ended up panning out. It panned out great. And then also communications also has done very poorly, and FDIS, consumer discretionary. The only thing I really missed was utilities, which is up 6.23%. One of the only sectors to date that's up, so I totally missed that, and I did not think that this bear market would be I didn't think there was going to be a bear market. This wasn't on my radar. But these sectors were, and this is how I kind of like to invest. So I like to just find the different tactical ways that I think are going to maybe outperform the market based on valuations of the sectors. Are the sectors cheap? Do they have a lot of headwinds or tailwinds right now? So I think about these things, and then I decide how to weight this. So going back, again, that's 25% of my portfolio. So as you can see, 25% is just like straight up a rules-based way of doing it. I don't have to do much. I just have to run the screener. This one, I have to do a little more. I have to think about like which sectors I like, so that takes more time. Then I got individual stocks. It's 35% of my portfolio. So whenever I'm doing like videos on stocks, like if I'm doing the NVIDIA video I just made recently, This is falling into this, right? So I'm trying to find stocks as well to go along with all these other things. This is a growth, value, yield. Like, I'm looking at everything and I'm trying to get a diversified portfolio of different things. It's valuation based and it's also technically based. So when I say that, I say I only will buy stocks that I think are good based on valuations. So that's why I do a weighted valuation. I usually do like price to sales along with free cash flow, along with EV to EBITDA, sometimes dividend discount. There's different ways that I factor each of these different stocks. And this one actually takes the most time, and it's the hardest. And it's probably performed the worst out of all of them so far because the stocks I picked, some of these stocks recently that I bought. Facebook has not done well. PayPal's down 12%. Bank of America down 18%. Did not think that was going to happen. Honestly, I thought Bank of America was going to be I thought financials were going to be good this year. So I actually got that wrong. Intel is one of the ones I invested in, pretty much flat in Intel. And so I bought all these because when I find a stock that I think is a good value that I like, I immediately add to the position. Doesn't matter what's going on technically. Then I kind of try to wait to see how the technicals look, and I try to enter the position based on if it is in an uptrend or a downtrend, or if it breaks out of a certain area, right? So I'm looking at the charts. I'm trying to figure out if I like the entry points. And if I do and I see something I like, then I add to that position, right? So I enter the position if I like the stock no matter what, and I add to it when I like it technically. So far, the strategy has been the most complicated and the hardest one, and I'm not sure if the way I'm doing it is going to end up working out long term because finding the stocks it's time consuming. So I don't know. I might change this up a bit, so we'll see. Basically, I would just change up the technical analysis part of it because that's the part that's I got to find so many stocks that are also having great technicals behind them, and that's not easy. The last thing I have are miscellaneous strategies. So these are considered high conviction. They can be sectors, they can be styles. So a sector, do I like one of them that I used here was energy. So I invested more in the XLE ETF, right? So an energy sector ETF, which has done well, which I'm very happy with. There's also different styles. So if I like, maybe for example, I like small cap stocks more than large cap. If I like small cap growth more than mid cap growth or large cap growth, I might try to find different little niches using ETFs and things like that. Maybe there's a specific industry that I like. Maybe I like biotech. This is just an example. I'm not saying I like that. These are just convictions that I have, and so I'm adding 10% based on these different things. Right now, I just have some money in both XLE and I have SCHD, the Charles Schwab high dividend yield ETF. And we have cash. And so cash is a peg. I don't really want more than 5% in cash, but unfortunately I have more than 5% in cash because of this part, which I'm having trouble finding stocks to buy. Even though there's a lot of stocks, of course, that are undervalued right now and it's a good time to buy. Technically, these stocks don't look very good, so it's actually been hard for me to find them based on the way I'm trying to do this. So we'll see how that goes. So anyway, that is how I am adding money into the market right now. This is my strategy. I like it because some of it is rules-based. I don't have to really think. I can just do. Some of it's a little harder and it's taking a little longer, and I might need to tweak it a bit. So we'll see, and I'll keep you updated. And at some point, maybe I will make a video on how this has been performing or certain parts of it has been performing or whatnot. And we'll see. Maybe next year I'll actually add money into a place where we can all track this publicly and see how it does. I don't know. So anyway, thanks so much for watching. I really appreciate it. Hit the like button, subscribe to see future content like this, and watch another of my videos coming up right now.